So that's now starting. So welcome everybody. Again, just a quick sound check. Everybody can hear. If Kelly or Alan, anybody, if you can just give me a verbal yes, type in yes, please. That'd be terrific. I just want to make sure that the recording is actually working. Fantastic. Great. Thank you very much for that. All right. So today we're going to cover something a little bit different today. And a little bit about where you're at in terms of your state of mind with your trading, what level of competency you're currently at with your trading. Remember, trading is a journey, and we go through different levels, different experiences, different stages of our growth as a trader, and it's important to understand where we're at in terms of those particular levels and have an awareness of those particular levels as we go through them. So just kicking off today with just an old Chinese proverb: learn something new each day, even if it is that what you learned yesterday was wrong. Interesting thought. So how to manage your trading risk and trading for a living. So some of this material that we're covering today is actually from a presentation that I do around the country, and there's some important learning concepts that I just wanted to share with you, rather than people who are perhaps at novice levels in terms of their trading. So again, before I launch into anything, I have to go through the disclaimer, and basically just to say, look, anything that we cover today, it's purely educational in nature. It's not to be construed as financial advice. General only. Please consult your licensed advisor before acting on any of the information. Yeah, I think most of you know enough about me. Again, I've been a trader and a trading coach for a number of years now. My favourite markets that I like to trade are generally the forex markets and the equity markets, and I've been doing a lot of webinars of late, running trading courses, member support. So this afternoon, what are we going to cover? Importantly, we're going to cover some of the concepts that are based on the 4 levels of awareness, and one of those being you don't know what you don't know. The difference between investing and trading. Our cognitive biases, what are they, and do they serve us well or don't they? Your risk management and developing a trading plan. Trading for a living. The fact that ignorance is not bliss. And one way sooner or later you come to that realization. Building a healthy equity curve, very important. So you don't know what you don't know until it's too late. So what does that mean? Well, if we think about that in terms of our level of awareness, we have what we call the conscious competence ladder. And just to briefly sort of describe, and then I might try and get a little bit of feedback from you, the level of awareness, if you like, there's 4 different levels that we go through when we're undertaking to learn anything new, and that's whether we're driving a car, whether we're learning how to knit, whether we're going to go skydiving, whether we're going to build a house, whatever it may be, for the very first time. And level 1 is where we don't know what we don't know. And when we think about this in terms of perhaps learning how the markets operate, I'd like to sum it up as being blissfully unaware, blissful ignorance, where perhaps at some stage it might be, generally this happens during a bull market, where we've accumulated some funds, we throw it into the market, and because the market's rising, everybody's making money, and we think things that, everything's sweet and dandy. So we're basically blissfully unaware of what the risks are associated with the market, and at that particular level, we're just an accident waiting to happen. We've all been through these levels before, and staying at this particular level is very, very dangerous, and the vast majority of the population are still at this level. They really don't have much of an idea of protective stop measures, risk management, the importance of position sizing, etc. The next level, stage 2, and this is where I reckon most of you are probably at, where you're developing as a trader. You've had some level of pain, that is, you've gone from being unconsciously incompetent, not knowing what you don't know, having suffered some pain, which is only natural, you learn through your experiences, had some sort of pain, and you've come to the realization, look, there's more that I need to know, there's more that I need to learn. And from that point of view, Some of you have suffered some, maybe some fairly severe sorts of losses. Just to give you a bit of an idea as the pain that I felt from going from level 1 to level 2, my pain was costing me in excess of $40,000 in losses. That's what it took me to realise that, hey, there was something fundamentally missing in my understanding of the way the markets worked. Now, for some of you, hopefully it's been less than that, but I know for a great many of the population it's been far more than that, and they still haven't learnt. So hats off to you guys, because you've put your hands in your pocket, you've done some trading, you've learnt, you've stepped out of your comfort zone to improve. So from that point of view, that's fantastic, because you're progressing further up the ladder. So that's stage 2, conscious incompetence, where we know that actually there's a few things that we don't quite know. So from that point of view, that's a good place to be, because then you can do something about it. Level 3 is where you start to, you've done some education, you're starting to implement what you're learning, and things are starting slowly to fall into place. And again, this is a fantastic place to be. The ideal way to get to level 3 would be terrific if you could just go from level 1 straight to level 3. But unfortunately our minds don't quite work like that, and invariably we have to go through level 2 and have that pain somewhere along the way to get to level 3. It's unfortunate, but that's part of my role, to try and get people to realise what they don't know and get them to level 3 as fast as possible. And then obviously stage 4 is what we're all striving for, complete mastery. So the example there might be, for example, driving a car. You're driving through the city, you know that you have to look in the rear vision mirrors, you don't even think about it. You put your foot in the clutch, you change gears, you slow down, you put your foot in the brake, you put the indicators on, it starts running, you put the wipers on, you don't really even think about it. But if you reflect back to the first time you got into a car for a learner's lesson, everything was just so foreign and awkward. The car would kangaroo jump along the way, you'd stall it, all those sorts of things, feels very, very uncomfortable. So you progress through those particular stages, and ultimately the goal is for everybody to get to complete mastery. And if you can start getting closer and closer to that with your trading, you're going to be in a position where you can start empowering others and start teaching others how to trade as well. So some of the symptoms that you're going to go through, and again you can talk to your family about these sorts of concepts as well. Stage 1, I remember this very, very clearly, that all I was thinking about was that we were focusing on the reward and ignoring the risks. Has anyone done that out there? Has anyone first thought about the markets and just thought, wow, look at the opportunity, and ignored the risk? Has anyone done that? Yep, absolutely. So easy to do, because we get so excited with it. It's just, particularly in a bull market, people putting money into the markets and away it goes. So we tend to have very little understanding of stop losses, the importance of risk management. We really fail to learn from our previous mistakes. We always blame something else. Oh, the market was against me. Oh, it was just a bad tip. Whatever. We're totally unaccountable. So we've got no concept of the impact of our position sizing. When I first started, I had to start off with a $5,000 trading account, and I was risking $1,500, $2,000 on a trade. I was an accident waiting to happen, and of course it did. So poor quality decisions. I had absolutely no trading plan. I didn't even know what a trading plan was. And the old saying, and I use this every day when I'm speaking with people, one way or the other, you'll pay for your education in the marketplace. And I certainly did. How much it costs is basically up to you, and that's where, if you can get your mind active and think about the long-term opportunities, etc., you really start to think, well, the importance of education is extremely high. So what's in trading? What's trading compared to investing? And in terms of investing, I want you to think about typical mum and dad type scenarios. Well, you yourselves as traders would realise that the importance of being humble, respect that the market is always right. So I want you to continue to think along the lines of the market. Pretend you are the market looking at a stock. You will form a view of a stock, whether it's going up or down or sideways. You need to start thinking like that, and if you keep thinking like that, it'll serve you, so much better than our old biases that we tend to have. We always endeavour to learn new approaches. So for some of you, obviously you've been trading stocks. It may well serve you in terms of your overall diversification and broader knowledge to start learning about some of the other markets as well. So some of the currency markets, maybe some of the commodity markets. Perhaps it might be some of the options markets, some of the strategies there where you can learn how to trade in different market conditions and different market directions. But importantly, as traders, we understand that we don't know everything and that we're continually trying to learn. So cognitive bias I just touched on before. What is it? Basically, cognitive biases describe the way that you think. The operative words there being cognitive, that is thinking, and biases, which is your prejudice. And what tends to happen is we tend to hang on to those biases even though they don't serve us very well. So if you think about it, the first thing we do after we've got a job and we've saved up some money, etc., we're wanting to learn how to invest. We might buy a house, we might think about the share market as an example. We've got our hard-earned money, and the first thing we tend to do is go and consult a broker. And the broker will tell us what he thinks of a particular stock. And he'll get that information from the research that one of his fund managers he's got contacts with may have supplied him. So that's only one source of information that he's used and that we're going to rely upon to put our hard-earned money in the market. Now, as you'd all know, simply by looking at a chart, we can tell what the market thinks of any individual stock. If it's going sideways, the market's undecided. Should we take any action? Probably not. If we know the stock is going down and our broker says, look, we think this is a great stock long term, what should we do? Have a look at the chart, which way is it heading, and then form our own opinion. So because Australians tend to like to buy things cheap, they tend to hang on to that type of bias in the market. And so therefore they tend to look for things that are cheap, stocks that are cheap. So they tend to buy things as they're going down. Now that we've all done the courses, etc., we should be fairly clear that that's the wrong thing to do, that we need to be looking for stocks that are going up, if we're going to buy them, or we're looking to short stocks that are going down. Okay, so it's a matter of twisting around your way of thinking. And this is where the resistance to change has a serious effect on your trading. Those people who hang on to their cognitive biases, they end up doing the same thing over and over again, expecting a different result, and that's Mr. Einstein's definition of insanity. Okay, so these are just important things that you've probably already experienced, but it's important to continually go back and think about the journey you've come through and tap into some of those thoughts along the way, because it'll make you a better and more proficient and more confident individual and trader in the market. So stage 2, consciously incompetent. You've had some sort of pain, some sort of experience. Hopefully it's been small. Hopefully it's been less than $40,000 in my particular case. You understand the cost of ignorance. If you keep doing the same thing over and over again, you're going to get the same results. You now understand the importance of capital protection. I say to everybody, the first rule of trading, protect what you've already got. Protect that capital. It's so important. Acknowledge the fact that you don't know everything, and you've all done that because you've all done some level of education and growing as traders. Accept your past mistakes and determined to learn from them. Okay, trading is a journey. So obviously, as part of that, part of our trading journey is developing a trading plan. Now, can I just ask, is there anybody who doesn't have a trading plan? It's okay, I'm not going to mention your name if you happen to type in yes or anything like that. Is there anybody that doesn't have a trading plan that they're comfortable with? Or is there anybody who is still in the process of developing a trading plan? No? Okay, well that's good. That's good. It means that you've got a plan of action, something to follow when you're engaging with the markets. You'll be surprised how many people don't have a trading plan. It's just absolutely amazing. So if you fail to plan, then you are planning to fail. The person who said that, an American president, Abraham Lincoln, all those years ago, and this is still relevant in the market today. So if trading is simply investing with a plan, then what do we call investing without a plan? You know the answer to that. Gambling. Okay, so as part of developing a trading plan, these are the things that need to be in your trading plan. And if there's any items here that aren't in your trading plan, then you need to start changing your trading plan to make sure you incorporate them. So definition of one's universe, what are you going to trade? The style that you're going to trade. Do you like action? So do you trade off 30-minute charts, or do you like to take things more easily? Looking at 4-hourly charts, daily charts, are you longer term, weekly charts maybe? What sort of strategies do you like to use? What are your rules for entering the market? What are your rules for exiting the market? How do you determine your level of risk on a trade or across your entire portfolio? These are things that are very, very important. And again, you'll be surprised how many people don't understand these basic tenements, if you like, in terms of developing a trading plan. The process for self-assessment. So are you, over a period of time, doing some self-reflection, some analysis on how you're progressing? Have you plateaued in your level of success? Are there some things that you need to go back and perhaps revisit? Okay, so it's that repetition of your learning that's going to make you a much, much better trader. And obviously having a process for adaptation and improvement to always, sharpen the pencil as you're going through with your trading, always looking to improve. So if you don't have if there's some things on that list that aren't in your trading plan, then effectively you're really starting to gamble with your money. Okay, so you just need to be very rigid about that. So risk management, this is basically a photo of me around about 9 years ago, and that mousetrap's just about to slam and cost me a lot of money. So what's good investing all about? Two things here. Is it about making money, or is it about protecting what you've got? There's a question. I'd just like a response from everybody. What's good investing about? Is it about making money, or is it about protecting what you've got? Is it about making money or protecting what you've got? Yep, Kelly says both. Anybody else? Any opinions? Yeah, Alan says protecting. Stephen says both. John says both. Well, I suppose the ultimate goal of good investing is to make money. Otherwise we wouldn't do it. But which is more important? Absolutely protecting what you've got. Because when we think about it, the only reason we're going to engage with the markets, we're going to swap the security of our cash for the risk of the market because we believe that there's an adequate payoff. So from that point of view, we're really thinking about the reward side of things. That's why we're doing it. But more importantly, we've got to have our protection on. Okay, so we've got to be wearing that hard hat in the market, so protecting what we've already got. So a couple of good points there, and feedback, fantastic. Exactly, and Kelly, as you've pointed out, if it's just protecting, then all we're doing is really, we're waiting for things to turn around the opposite way. So our goal is to make money, but very importantly, very, very importantly, we have to protect what we've already got. Great point. Okay, so risk management, winning investors make money in a bull market, so as the market rises, we profit from that movement. Importantly, make money in a bear market. GFC, now some of you have just sort of done training, done your courses over the last 18 months, 2 years. If you think about the value of what you've learned in those couple of years, if you could go back in time to February 2008, think about the opportunity that would be presenting itself, even though you don't know what was about to happen. During that particular time when the market was in free fall, the amount of opportunities to profit from that bear market was it was mind-boggling. It was a sort of event that happens probably once every 20 or 30 years. The fall in the market was just absolutely amazing and a massive opportunity to profit from. This is the difference between winning and losing investors. Losing investors make money in a bull market because everybody does. Put some money in the market and away it goes. But as soon as things turn bearish, they lose money in a bear market, and they lose it big time generally. And a great saying, losing investors, they mistake brains for a bull market. Okay? You'll know somebody is a good trader when they make money not just in a bull market, but in a bear market. So this is what basically winning investors do that losing investors don't. We understand how to protect what we've got by managing our risks. It's a huge difference. It's only a small difference, but it is significant. Risk management and diversification. This is a really important concept because whilst we've covered the skills so far, the basic trading strategies, money management, position sizing, directional type strategies, there's a lot more to it than saying, okay, I've got those things covered, I can now call myself a trader. Because being a trader, in the truest sense of the word, means that you need to start to consider overall portfolio management and be looking at different markets as well. So the way that we do that is we look to diversify. So question there, what normally springs to mind when you think about diversification? What does diversification mean? Narinder, what do you think diversification means? John? Stephen? Yeah, many different things. Yep. Okay, well, diversification, if we think about it, it means, you know, not putting all our eggs in the one basket, so to speak. So Chris, fantastic. He's talked about longs and shorts. So perhaps diversifying in terms of the way that we trade. So we're not just looking to go long, but we're looking for opportunities to go short. You'll be surprised that, you know, most investors, all they do is they go long. They don't know anything about going short. So they're really, you know, pretty much a slave to the markets. Looking at other markets as an example helps to diversify as well. So let's go through and have a look at just some examples of what this actually means. Alright, so professional investor, trader will look to diversify in a number of ways. One of those is across a market. So as an example, as you're pointing out there, looking at different classifications within a market. So it might be different industry sectors, for example, that you may be looking at. So rather than, you know, looking just at the mining sector, you might be looking at the financials, the small industrials, the retail, although the retail you probably wouldn't be looking too heavily at the moment unless you were looking to go short. Again, by spreading your risk across those different industry sectors, it helps to lower your overall portfolio risk. So as an example, you know, you might have some mining stocks, and then you might have some banking stocks, you might have some energy stocks, etc. Obviously, diversifying across different markets, getting access to other markets that may not be present in the Australian market, as an example. Different asset classes. We've got housing, property, cash, shares, bonds, currencies, commodities, and again, different directions that Chris pointed out. Different investing strategies. There's a number of those that we can take advantage of as well. So across the market, so different market capitalisation, so small caps, mid caps, large caps. Different sectors. Again, we're not putting all our eggs into the one basket. Different markets. The US market. You think about what the US market's done to the Australian markets. Our market, in the trading room every day we talk about how dreadful our market is. Certainly there are some great stocks and great performing stocks in our markets at the moment. Some really good longs that we've seen. But the bigger stocks and things like that have just been dreadful. The whole market has been pretty much sort of broadly moving sideways. But you compare that to the US market's just been powering along. So again, the benefit of being able to diversify those strategies across markets. Different asset classes, commodities, FX, bonds, etc. Again, knowing how to trade those has just been terrific. And Chris, you're quite right, the US market has been a nest egg. It's just been fantastic because there's so much capital in those markets at the moment pushing it higher. The trading opportunities, and particularly once you learn a number of different strategies, has just been tremendous at the moment. Different asset classes, commodities. you know, there's been some really good trades on some of the grains and things at the moment, and they tend to move in different cycles at different times. So there may be times when our market's going, you know, sideways or down, but other markets can be going up. And so it just gives us, you know, a broad range of opportunities to be able to trade and minimise our overall level of risk. Now this table is really interesting. It's a little bit old. It's about 18 months old now. But what this table does is it shows that if we were only invested in the ASX 200, that over the last year, 2 years, 3 years, 5 years, that if you could only go long on Australian shares, these were the sorts of returns that you were getting. Now if you compare those sorts of returns, now by going long only, I mean this is pretty much a super policy. Okay, so it gets invested in the market, we get terrible returns over a couple of years, they're just starting to come back slowly. But if we look higher up the table, we'll get to see that there are some other markets that have been performing brilliantly. And so this is where having an awareness of other trading strategies, other markets, provides enormous opportunity. So why limit ourselves to one particular market? Okay, so risk management, because we don't always see it coming. I like this photo with the guy getting hit in the head with the soccer ball. He certainly didn't see it coming. Always good to have some shorts in your portfolio. And the reason for this is that when markets move up, they don't move straight up. They have pauses and they may well have pullbacks. And just by having some counter trades in your overall portfolio, so if you had 10 trades, for example, you might have 8 or 9 longs and you might have 1 or 2 shorts. When you do get those pullbacks, those short trades outperform. And what they do is they actually minimize the overall damage to a generally long portfolio. And so the benefit of that is obviously that whenever the market starts to have a fall or a pullback, it offsets some of the losses we have on our longs. So that's an important concept as well. The other aspect of risk management and diversification is using different strategies. So as an example, through our SMA workshops, which are now called Trading Plan Plus, or any of the live data workshops that you've attended, you would have learnt, you know, strategies for capturing strong trending moves, whether that's to the upside or to the downside. There are other strategies that are very, very good for sideways ranging markets. And there's a particular option strategy that we teach, where the concept effectively is that we're looking for stocks that are trading within a particular range, up and down, up and down, up and down, really going sideways. The market really doesn't have much an opinion of these particular stocks. And the way that I like to paint a picture for you is that by becoming or performing the role like an insurance company does, we can actually extract cash from the market. And the way that we do that, if you imagine your insurance company, every year they send you a bill. They send you a bill for your car or your house or your contents insurance in the hope that you're not going to claim on it. Okay, so it's a little bit like having, as an example, housing protection insurance on your house so that it doesn't burn down or it doesn't flood. Now each year, because it's unlikely that these events are going to occur, i.e. it's unlikely that the price of this particular stock is going to get this high or this low, in the unlikelihood that it does, the insurance company receives money from you every single year for protection. Okay? And if your house doesn't burn down, you can't go over them and say, look, my house didn't burn down, can you give me my premium back? They'll just smile and say, look, I'm sorry, that's not our policy. And that will happen at every single insurance company that you go to. So the concept is there, if we can find stocks that are in a very much a sideways market, then we can actually, through a particular option strategy, we can get cash out of the market each month. And it's basically a form of, if you like, selling insurance. It's a little bit like pretending that you are the insurance company. You're taking in this premium month after month after month in the event that the stock continues to drift sideways. Okay, so that's just a different type of strategy. It's not one for everybody, but it's just a different type of strategy for different market conditions. So tips for those who are wanting to trade for an income. Now, people trade for different reasons. It may be just for a bit of extra cash flow. It might be the idea that people want to become a professional trader over a longer period of time. You might want to teach, teach your parents, teach your children, for example. There's a couple of concepts that you need to cover. Now, obviously, understanding technical analysis, we've spent a lot of time on that. We need to trade with the pros big picture. So I continue to try and reinforce, hey, put your market hat on. Think about it in terms of what the market's doing. We also need to use short-term timing signals. So these are really just recaps on some of the concepts that we've covered. But question here, not everybody attending today's webinar is necessarily been at all the previous webinars. So I won't assume that everybody knows the answer to this question. And the question is, who would buy this stock? Seeing that that's a chart of price over a period of time, I'd just like you to type in yes if you would buy that stock, or no. All I'm looking at is that chart over a period of time. Who would buy that stock? Yep, Kelly says yes, Chris says yes, John says no, Stephen says no, Narinda says yes. Okay, interesting. Trends illustrate the imbalance between supply and demand. Now, it's very tempting to look at this stock and say, hasn't it moved a long way? It's gone since August from $14 to $31. The only reason it has gone from $14 to $31 is because there is more demand for it than supply. Now, if you're going to own a stock, you would much prefer to have demand on your side than supply, because if there's an excess of demand above supply, the price must go up. Okay? It is very easy to look at that and think, how on earth could that go up any more? Surely that's as high as it can go. And this is where your cognitive biases, your original way of thinking, is not going to serve you well. Because we need to think in terms of probabilities. The fact that it has come from $14.50 to $31 in a fairly short space of time shows that there is ample demand for this stock. Ample. So the probabilities are, given where it's come from and where it's gone to, it is more probable for this stock to continue on its merry way higher and higher. Is it possible that this stock may well fall? Yes, it is possible. But it's more probable that it's likely to go higher. So from that point of view, we need to start thinking about stocks like this being cheap, because there is so much demand for it. Now, at $31, it did look as though it had a pretty good run. I agree with that. But the fact of the matter is that demand for this stock outstripped supply, forced the price up. It's the only way the price can get there. And demand continued for this stock and pushed the price all the way up from $31 all the way up to $60. This is where you need to retrain your brain, or challenge those earlier cognitive biases that you have, because they're not going to serve you well in the market. You need to put your market hat on and think like the market. Okay? Because that was a massive opportunity that by not getting in here, we've missed out on a stock that's gone from $30 to $60. Could it have gone down? Of course it could have. Okay? But we're talking about probabilities versus possibilities. Okay, here's a stock here that, again, I like to look at stocks in the other direction as well. Here's a stock that from left to right, like reading a book, is going in a particular direction. And again, question, and I'd just like you to type in yes or no, who would buy this stock? Type in Y for yes, or yes, and N for no. Narinda, no, fantastic. Chris, no. Kelly, interesting. Stephen, no. Alan, fantastic. Okay. All right. So the question was, who would buy this stock as opposed to who would trade this stock? So, Kelly, you said yes. I said, would you buy this stock? Did you want to change your answer? A little trend line starting. Okay. If you're looking at the far right-hand corner, down here, we've got a short and medium term uptrend here. It started to turn down again. If you look at this from left to right, looking at this chart, the price has gone from $26 March of last year all the way down to $12. Okay, so the overarching opinion, if you think about what's moving any stock in the market, and I want you to think about this, it's not you and I who have the opinion on this stock. It's the broader market. And the broader market is made up of big institutions, fund managers, pension funds, insurance companies, banks. Remember, they've got all their teams of analysts crunching over the numbers. Okay, they're looking at the economy, they're looking at the management of the company, they're looking at the future earnings, the forecast earnings, etc. They're looking at the competition, they're looking at the political environment, etc., etc., etc. They will form an opinion on this particular stock. They will tell their fund whether they should be acquiring this stock or getting rid of it. Looking at that chart, the overarching opinion here is that they should be getting rid of it. How do I know that? How do I know that the overarching opinion of this stock is that these bigger entities would prefer to be out of it? How do I know that? How do I know that? Think about this in terms of demand and supply. Is there more demand for this or more supply? What's larger, the demand or the supply? More supply. Narinder, fantastic. Supply is outweighing demand. Okay, now if supply is outweighing demand, then that means that the price must go down. Why is there more supply than demand? I don't know. However, the fundamentals somewhere along the way are suggesting to the bigger players in the market that this company is going to struggle. And technically, as Chris has pointed out, they're fantastic, lower peaks and lower troughs. Okay, these lower peaks along here and lower troughs all the way throughout are symptoms of the larger players getting out. Now think about it. If you're a fund manager and your analysts say, look, we want to be out of this particular stock, and you might have, I don't know, $100 million worth of this stock that you need to start liquidating out of your portfolio. If you try and dump that $100 million of stock on the market in one day, what do you think is going to happen to the price? You may well have an impact on that price where it starts to plummet really quickly, and you do yourself no good by doing that. So they'll start liquidating their positions over a period of time. They might dump 5 million one day. They might drop 10 or 15 the following day, and they may well see that, gee, the price is really starting to move down. So at that point, are they likely to start getting rid of more of their portfolio, or do you think they're more inclined to wait until the price starts to move back up again, dump some more, and away it goes? So that's why we tend to get these lower peaks and lower troughs throughout. Now this particular stock, it did have a level of support here through about $16. So that means that because there's a level of support under here, it means that there's some demand below, some demand just pushing the stock back up, some demand pushing it back up, some demand pushing it back up. But as soon as it gets to a certain level, around $18 for example, it starts to move back down again. Back up to 18, move back down. Back up a little bit high, maybe 19, 19.50, but no sooner than it does and it gets smacked down. It's going sideways. Okay, so there's a strategy there that we could use, an option strategy. But this particular stock, and I've mentioned this before, and it's just worth mentioning. A lady asked me, I've got this stock, what should I do with it? And all I said to her was, well, I can see quite clearly that there is a level of support at $16. Should that level break, I would not want to be in this stock. My doctor has this stock, and he tells me how good this particular stock is, loves the stock. loves the stock. It gives a 10% dividend yield, he says. Great company, great management. Well, obviously, the bigger players in the market have done all their research and they have a different view. And the name of this stock, whilst expensive on the way down, is QBE. Okay? Now, just about everybody I talk to has had QBE at some stage. And you think about what it does as an insurance company. Now, I don't know too much about its fundamentals, but I do know that it would be insuring all those people who had floods and fires and those sorts of things. There's been a lot of that happening on the market. That's the limit of my fundamental analysis. All I have to do is look at this chart and I know when this stock's in trouble. If it's heading down, okay, it's in trouble. Does that provide a good trading opportunity? Absolutely. Okay, absolutely does. Some great shorting opportunities there has been in this stock. Okay, some other concepts. Obviously you guys are pretty much on top of this, but it's worth remembering. Your candlestick formation, your patterns that we teach in the workshops. Black candles, sellers are in control. So again, just to reiterate, a black candle means that the stock has opened up high and closed low. A white candle, which is a bullish candle, in this particular instance, opened low and closed high. So candles do give us, if you like, good tip-off points about when to enter a particular trade. So a couple of quick questions. Okay, who's in control at this point? Who is in control at that point? I'm just thinking to myself, who's going to be the first person to answer? And that person I picked, two of them in fact, very quick on the button. I won't mention who they are. They know because they typed in the answer. Okay, next one. Who's in control there? First person again, I think will be... it surprised me. Okay. Well done, Kelly. Named you. Fantastic. Narinda, thanks. Alan. Chris. There. Who's in control there? Could you repeat the candle colour, please? Yes, Stephen, I will. Okay, so when we have white candles, a candle will be white when the close of the candle, the close of that day, is higher than the open. So if I take one in isolation, this big white candle here, this is where the candle opened and the candle closed up here. Now because it closed higher than when it opened, the candle is white. However, when we have a black candle, for example this one here, this stock opened up high and closed down low, and because it closed lower than when it opened, the candle is coloured black. Alright, so the black candles mean that the sellers are in control, whereas the white candles mean that the buyers are in control, okay, on that particular day. So who's in control on that day? Stephen, that big white candle there, that means buyers or sellers? Buyers. Thanks, John. Fantastic. Okay, next one. Who's in control there? First person this time. Terrific. John, very quick on the keyboard. Narinda, fantastic. Stephen. Stephen. Black candles. Okay, black candles, so the close is lower than where it opened. This particular stock here, it opened up high, closed down here. Next day, opened here, closed down there. Okay, so very much the sellers are in control. Okay, the sellers are in control. Okay. Right, so stage 3, consciously competent. You know what you're doing. Okay, at this stage, you've committed to a more disciplined scientific approach. Now, most of you guys are going to be somewhere between 2 and 3. Some of you might still be between 1 and 2 if you haven't been practicing everything that you've been learning, coming to the webinars, reviewing the recordings, looking at your trading notes, looking at your course notes, etc. But hopefully you're somewhere between 2 and 3. And I know some of you are well entrenched in stage 3, and it won't be too far before you start moving on to that mastery type of situation. Now, it's going to take you a lot longer to go from 3 to complete mastery, But the fact is, when you're at stage 3, good things start to happen. So you've already committed to a more disciplined approach, a scientific-based approach. You've got a robust trading plan. You've created one. You've been committed to learning more about not just trading, but embracing other security classes. So you're not just stuck on your equities, for example, because there's a world of opportunity out there in different markets. You've committed to learning more about portfolio management. So splitting up pieces of the pie, so to speak, so that you're not putting all your eggs into one basket. I'm really getting my analogies and metaphors mixed up there, eggs and baskets and pie, etc. It sounds a bit like I know, baking a cake or something, but I think you understand what I mean. You're also committed to learning new trading approaches. Okay, so again, different market conditions. So it's not just long and short, sideways markets as well. Think about that, some of the opportunities there. You're humble, you're seeking out experience, seeking out to expedite. That means to hurry up the process, because you realise that if you sit there trying to learn it all yourself, time ticks on by. And you've got a steadily rising equity curve. You will know when you're at stage 3 properly, when your equity curve, which is basically just a measure of your performance over a period of time, is on the rise. If it's not, you need to seriously think about where you're at with a trader, and looking and sitting down reflecting on what gaps there are in your knowledge. Okay, so an equity curve, as it says here, is simply just a chart of your trading capital in the markets. We want to try and maximise the returns whilst minimising risks, and obviously thinking in terms of drawdowns. So a good equity curve is a steadily rising one with small dips. Okay, so how do we do it? We've got several advantages here. If you think about different sorts of markets that we've got, and how, as traders, we can benefit from different market conditions. Over a period of time, your superannuation, it's invested in the market, okay, unless you are self-managing it. But your normal one that's not self-managed, the fund managers will put it into the market, and over a long term they'll tell you that markets will outperform and you'll get good returns on your capital. So over a period of time during a bull market, yes, your nest egg starts to grow, until one day we have a GFC or a massive market correction, and the value of your super has gone from here down to here. This has happened with literally thousands and thousands and thousands of people, because they had no concept of risk management. They left it up to somebody else to take responsibility for their outcomes. Okay, those people are generally at stage 1. They're blissfully unaware. They have no concept of how to manage their money or their risks, and this is what happens. However, as a trader, when the markets are rising, we benefit from those market moves. As the market has retracements through good money management, portfolio management and trading strategy understandings, we don't experience too much in the way of drawdowns. But when a bear market occurs, this is where we really stand to make a lot of money, because we understand risk management, we understand trading in line with the overall trend, and it means that we can continue to grow our portfolios whilst everybody else suffers, unfortunately, is a victim of the market and experiences this big dip in their equity curve. Okay, so that's what happens to average investors, and I know you guys are well past that, so I may well be pointing out the obvious, but it's really, this is why you trade. Okay, this is why you trade. So if your performance doesn't look like the green line, then you're not a winning investor. Now, the way that you can tell you're on the right path is that you've established your own equity curve, and if you haven't done that yet, then you need to start doing it, because otherwise you can't, you have no benchmark. Okay, so this is the ASX 200 over about the last 12 months, thereabouts. Interesting to note that we were pretty close to about the 5,000 mark, and we're now sitting at 4270. This is as of a couple of weeks ago. Might be slightly higher, but the last couple of last 6 months really going very sideways, very difficult in terms of looking at the overall market. So you need to think about that as being an equity curve. If you were invested, your superannuation was invested in the top 200 shares in the Aussie market in a long-only portfolio, which is pretty much a super policy, This is the performance of your super fund. So if you had $5,000 in your super fund 12 months ago, today it's worth $4,268. If you had $50,000, it's now worth $42,680. If you had $500,000, it's now worth $426,000. So you are pretty much a victim of the markets. That's where it's going to go. But as a trader, you can do a lot better than that. Okay, because you know what to do. You know how to trade. Just to illustrate a point, this is an equity curve of my 14-year-old daughter. Now, she's not actually allowed to trade, so I have to place the trades for her. Interesting to note, I gave her $5,000 to start with, and I said, well, look, I'll have the losses and you can have the profits, because I wanted to teach her how to trade. Now, using only 2% risk management along the way, as like we teach in the workshops, etc., she's been able to, over an extended period of time, 12 months, through constant application of the trading rules, etc., turn her $5,000 trading account down here to over $6,500. She's had some great results, particularly in the last few months, with some really great trades, because there's been some fantastic opportunities in the marketplace. So a 14-year-old girl has been able to turn $5,000 into $6,500. If we go back to the slide, $5,000 invested in the ASX 200 is now worth $4,268. So whilst the market has gone down around 10 or 15%, we can see that my daughter's account has gone from $5,000 to $6,500. That's a 30% increase versus a 10 or 15% drop in the ASX 200. This is why you become a trader. This is why you establish an equity curve. This is why you learn about risk management, position sizing. So, question. I'm just wondering where we are now. Okay, some feedback. Is anybody at level 1? Kelly, good question there. Just over 100 trades she did over the course of the year. Okay. Blissful ignorance. Please don't anybody say you're blissfully ignorant. You can't be, because you're here. Okay, those people who are blissfully ignorant, they're doing something else. Okay, Alan, fantastic. Between 2 and 3, great. Because the great thing about that feedback, Alan, whilst you might say, well, look, Dave, why did you mention my name? The fact that you've acknowledged that shows to me that you're seriously thinking about where you're at in your journey, and that's really important. Chris, level 3, fantastic. That's great, because, and I know this through Chris because I've had a fair bit to do with him, and he's been to a number of workshops and courses and things like that, that he's very serious about his trading, and that just means that he's continually reflecting, he's learning new strategies, he's listening to the market and trading accordingly. He's not trying to fight it. Okay, Stephen, fantastic, level 2, great. Chris, full-time job, fantastic. So here's a guy who, you know, has done a course probably 18 months ago, 2 years ago, might be Chris, who's been able to, through that time, through that particular journey, learn along the way. Now, I'm not going to ask you, Chris, well, I will ask you, Chris, did you experience any pain before you got to those levels? Just waiting for Chris. I'm thinking he's probably going to type something. Yeah, Joji, between 2 and 3, fantastic. Joji, I know you've been to a workshop, great. Yep, Chris, fantastic. Okay, Chris, just give me some feedback about, you know, some pain that he's experienced along the way. As I pointed out, my pain at the beginning was $40,000, and that's not including what my financial advisor told me to get into at the same time. Pre-2000, he said, "Oh, David, I think some managed funds would be good." And I parted with about $30,000, and I put it into health and biotech and the infotech technology sector. Pre-2000, you might remember what happened on the NASDAQ after 2000, and bingo, just disappeared. Never had it again. So it was just one of those things that I just didn't know, and that was my blissful ignorance. Thanks, Georgie. Thanks for that bit of feedback. So to me, you know, it just cost a lot. You know, cost a lot. And so it's one of the things that you know, your education. I just really admire everybody for taking the effort to learn something, and you know, it's one of those things that you have for the rest of your life. Once you learn how to do it properly, this is the sort of thing you can teach your kids. It's just really, really important. You spend so much time earning your money that to then go and throw it into the markets and expect, you know, a miracle is just gambling. So that's great. Yeah, good feedback, Chris. Thanks, Kelly, as well. So that's level 1. Okay, we've all been there. So part of my role, obviously, is to encourage people to try and get from level 1 to level 3 as soon as they can, and try and minimise that little bit in the middle, that aha moment where you go, the transition kind of stage. That's really important to bypass that. So you've acknowledged mistakes, you know, learning how to trade, etc. Robust trading plan, profitable. Okay, profitable. Okay, so you do need to create that equity curve. So if you haven't started doing that, get it done. Okay, get it done, because once you start to do that, you'll then have a benchmark. You'll be able to go back and say, where am I up to? What are my results? And remember, don't look at your results over, you know, a week or any particular month, because you can have months when your equity curve starts to go down. You're going to think, oh, it's going the wrong direction. Look over, you know, 4 months, 8 months, 12 months, you know, quarter by quarter, that sort of thing. It's what you really need to start thinking about, because that's the true measure of how you're performing. Okay. Level 4, complete mastery. Complete mastery will occur over a period of time. You can be mentored along the way, and that certainly does help, because mentoring just keeps you on the straight and narrow. You're held to account. If, for example, you're not terribly accountable to yourself, you're held to account. It's a little bit like, I suppose it's a little bit like The Biggest Loser. You watch that on telly, and a lot of people there have perhaps have mind issues and things like that they need to get straight, and they have a personal trainer. And the mentoring type of thing is a bit like a personal trainer. It just keeps you accountable, keeps you focused on the process as opposed to the outcome. Okay, keep thinking about the process. Very, very important. Yep, fantastic, Chris. Lots of different business plans for different markets and timeframes. Fantastic. So really good awareness of your own periodicity, the way that you like to interact with the markets. Understanding that is really, really important as well. So again, it's a bit of a journey of self-discovery, and the sooner you can learn about these things and start thinking about them, the faster you'll progress in the markets. So it's really, you know, the purpose of today is to think about where you're at, and to encourage you to think about other courses. Now, you know, we do run what's called a master course. Okay, now a number of people have done this, and I think Chris, you've probably done you know, several of our courses already. And the important thing about this particular course is that it dovetails very, very nicely onto what you've already done. Okay, so your Trading Plan Plus, for example, those who've got Learn to Trade at Home, it's a dovetail for that will introduce you to a broader range of strategies. Okay, so again, in terms of your diversification, what you're looking to get out of the markets, your risk management, etc., your trading strategies, this is what we teach, and this is an offer that we've just put together only for the webinar attendees. So it's only for you guys. So today we've got about 14 or 15 of you here. Nobody else is getting this offer, because you guys have taken the opportunity to you know, to listen to me, and hopefully, you know, I continue to sort of encourage you, inspire you to think about your trading and you know, strive for that next particular level. Now, this is what the master course includes for those of you who haven't done it, just for a bit of your own information. Trading Plan Plus workshop, which most of you have done, which is a 2-day workshop with Carl and myself. It includes a fast track FX workshop. So again, that particular workshop is held by probably, I'd like to think of Kel as being one of the most inspirational traders that I've met, because he tells it like it is. It's no you know, airy-fairy kind of this is how much money you can make. It's very, very black and white, and the things that I've learnt off Kel are just invaluable to me in terms of his mindset about the markets, how it all works, level of risk, and just the fact that, you know, at the end of the day, your job as a trader is to take the trades when they appear. And that's a fantastic course to be able to do, to be able to learn how to trade those currency pairs in either direction. We have a new workshop that we're introducing as part of the master course. It's called Beyond Charts. We have used for many years a program called Metastock. Beyond Charts is similar to Metastock, but the one of the challenges for Metastock is the programming language that people have to familiarise themselves with in order to program Metastock to find the trades that they want to. So what this Beyond Charts workshop does is basically takes a lot of the Metastock language, but it simplifies it into a number of scans. So what we can do with the Beyond Charts program is actually embed it with a number of the strategies that we use at the workshops, and it's essentially one-click scanning of the market, finding those sorts of trading opportunities, pointing out entry levels, pointing out protective stops, potential profit targets, finding the strongest sectors within the market, doing those relative strength type scans as well, and that's a terrific program that we've got, and we'll be running workshops on that as well. Options Edge, that teaches us about strategies for different markets, so not just directional based moves but also sideways based strategies for the market, so we can take cash out of the market. Yes, it is, Chris, to answer your question, it is an ASR developed software, and the benefit of that will be it'll just make the process so much simpler, because you'll be able to log into your Beyond Charts, run a scan at the end of every day, and from that point of view, yeah, no problems, Susan. From that point of view, it'll just be one-click scanning, so it'll just make things a lot easier. You'll also get the Learn to Trade at Home. If those of you don't already have it, you'll get some broking credits from IG and also from E-Trade. And again, you get unlimited re-attend to all the workshops over the course of the year, all your webinars, your educational portal access, etc. Now, normally, all of that is $12,452. But we run a special on it for $7,952. Okay, so that's the regular price. That's what it's worth. That's the regular price. But because you guys have sat there and listened to me, and hopefully I've inspired you to think about a few different things, we've reduced the cost of this by the value of the education that you've already invested in. So as an example, if you've already been to an SMA workshop, as an example, that the cost of that course would have been around about $2,990. You can deduct $2,500 from the regular price, which brings the price of your master course down to $5,452. Those of you who have done the Learn to Trade at Home, you have a deduction of $1,990 off the original master course price, and that will bring it down to $5,962. Now, I know for a fact myself that the courses, if you're investing in the market, that your courses will be tax deductible. Okay, it's not accountancy advice or financial advice. Speak to your accountant about that. But for all the courses that I've done over my trading career, I've always been able to claim the cost of education because I'm investing in the market. And so I think that's one of the few nice things that the taxman actually does for us. So from that point of view, if you think about the pain that you may have experienced along the way and the opportunity to improve your knowledge and understanding of not just one particular market but a range of markets, I think the price, the reduction in the price there is fantastic. And if I had my time again, the one thing I've really liked about all the ASR courses is first and foremost risk management. Okay, every other course that I've done, it's always been about how much money you can make and not what you can lose. Okay, so the risk management is paramount, and you know that from your own level of experience and trading so far. So this is an offer that's only available to you guys, okay, not to anybody else, because you're current members, because you've been to workshops, because you're on your journey, okay. And as part of that journey, I certainly encourage you to learn as much as you can at every opportunity. We do run, other than the master course, we do run a mentoring course. Carl's got a mentoring course where he's got around about 30 people, and he runs a webinar like what we've gone through today every single day. Every single day. Goes to the market, runs his scans, talks to each of the mentor clients about potential trades, their trading plan, one-on-one for 12 months. So if you can imagine having somebody, an expert trader in your back pocket for a mentorship role, that's fantastic. So it's something you can do. Yeah, no problems, Chris. We'll catch up with you tomorrow. So again, that's a little bit further down the track for those of you that perhaps want to be mentored. But it's important along the way that you're building those foundation blocks. So that's pretty much it. I just wanted to make you aware of that potential offer. Encourage you to consider it. And again, hopefully, by tuning into these workshops, we learned something today that some of the things about where you're at as a trader, your level of competency, just touching on some of those things that might help us to become successful in the markets. So I'm just wondering if there's any questions today in relation to that. I haven't got my stock charts up today, but we can have a look at that next week. Is there anything that perhaps any questions from today? No? Okay, Stephen. Okay. Well, that's all right. Look, that offers, as I said, it's for you guys only. So if you want to give any one of us a call at ASR, please do so. Just mention that the webinar offer, and we'll see if we can do anything for you. We'd certainly love to see you at some of the workshops, and again, be part of the broader trading community. You'll learn a lot from being associated with other traders, and filling your head as you go along. So again, just challenging yourself and always striving to be the best person, the best trader that you can be. So with that in mind, I'll sign off now. Our next webinar will be in around about a fortnight's time. Again, don't forget, I am available on email, and it's just dmcculloch@australianstockreport.com.au. I've had a few emails from you, Kelly. And yeah, just enjoy the interaction, etc. And again, have a think about the upgrade offer, because it's certainly, it's value for money. You know what you get each fortnight. From myself, that's just the tip of the iceberg. Anyway, we'll speak to you next week. In between now and then, good trading.